Morning, everyone. Thank you for joining. Maybe not an exciting topic. Maybe you think you know a lot about this already. Just a quick question. I just hope everybody can hear me safely. Maybe put a hello in the chat box just to confirm. Okay, right. Welcome, everyone. So, autumn budget 24, biggest budget probably actually since Gordon Brown delivered his first one and his second one. Very clever man, changed everything in business tax. This one doesn't change everything, but it is certainly quite impactful, shall we say. Quick introduction to myself. Probably most of you know me. Malcolm Veal. I'm a director of Naked Accounting. We're a small zero-based tax advisory, outsourced management accounts, VAT, payroll, etc. firm. I've been in this tax game, as you can see, for a long time. I've seen off 13 chancellors. Today, I'm going to run through the rate changes, etc. But you've probably seen all those. But really what I'm going to try and do is to zero in on how these may affect this audience. So we've probably not got a lot of farmers or non-DOMs or large-scale financiers or anything like that in the room. The things I'll be focusing on: the employer's national insurance changes, with maybe some surprising numbers, the business asset disposals or retirements, the new tax on pensions, although that's a bit vague what we've got at the moment, MTD, that's making tax digital, who it affects, and one or two other comments, and just one or two comments about the contracting world, R35 and umbrella companies, plus a few standalone pointers and tips. There'll be no politics today. There might be a bit of cynicism, but there won't be any politics. Now, the next couple of slides, I won't dwell on, but I'll just quickly run through them. They kind of set the scene for what this budget does. New government, fresh approach to fiscal policy. And I said no politics, but it's definitely the case that Rachel Reeves is a very intelligent person who understands a lot of things and is a very details-led person, as well as broad-based approach to changing things. We've had slow economic growth. There was a lot of talk about the budget deficit, the black hole, as they were calling it. Then she said the black hole's bigger than she expected. She said it's a 47 billion gap, a 47 billion black hole. So this budget raises taxes by about 40 billion. Interestingly, 7 billion less than the gap. But in this budget, instead of short-term fixes, the budget emphasised long-term stability with a focus on growth. And the Chancellor, she set her sights on changing the economic landscape, especially the last bullet on this slide, trying to get long-term stability, because obviously, again, no politics, we've had a lot of changes in all sorts of ways over the last 5, even 10 years, but especially the last 3 or 4 years. So the aim is to get economic prosperity, although obviously there's hard medicine to swallow at the moment. It builds on this budget, the budget builds on the deficit situation. The OBR, the Office Budget Responsibility, predicts growth at 1.1 to 1.8% in 2026. Who knows? That's the aim. The aim is to stop austerity, but you can't do that immediately. To be fair, I think the budget does try to prevent austerity in the short term on spending. There's a lot of money for the NHS. The borrowing is exclusively for investment in projects, not for day-to-day spending, not for revenue spending, as they say. But to be honest, that is a promise that I have heard quite a lot of chancellors make. We'll see if it pans out. Okay, now I should have mentioned Anissa Umar, my colleague, is here in the background. If you ask any questions, do please ask as we go along. Put them in the chat, please. Anissa may answer some as we go along in the chat, and primarily we'll answer any questions at the end. If I have an IT issue or whatever, then Anissa will step in.
Yeah, that's fine.
Thank you. Okay, so on to the taxes. And the big one that for most people, the one that got a lot of publicity. And it's headed a tax on employment. And there's been so much discussion about this. Just to quickly give the picture you've probably got from the press. Rachel she reaffirmed their electoral commitment not to increase income tax, VAT, or national insurance for working people. But it does introduce significant changes for employers. And the big discussion has been, does that really affect employees as well? Although it's not a direct tax that they pay. I'm not going to even think about going into that discussion. The big change is from April 25, next April, not from the budget date, the rate of national insurance employers' national insurance contributions. Employee national insurance contributions not changed. Employer national insurance contributions will rise from 13.8%, which has already gone up over fairly recent years, to 15%. That's adding an estimated 25 billion to the public finances. That's the big tax raiser in this budget. And also, at the same time, the threshold at which employers' national insurance kicks in will drop from 9,100 to 5,000 per employee. That means another £4,100, which has employers' national insurance at 15%. And just to do the arithmetic, that's £615 more for the employer to find per employee. Not in all cases, we'll come to that. Plus, employers' national insurance doesn't stop. Employee national insurance almost stops. It drops to 2% at around 50,000. But if you've got a really high earning employee, maybe that's you. Everything above 50,000 still incurs employer national insurance at 15%. That's the big one for high earners. Remember, national insurance is per employee per pay period. So if someone has 5 jobs, one each day of the week perhaps, at £5,000 per annum as a salary, instead of one at 25,000, there's no national insurance. There's none. It doesn't work like tax. Tax in your pay slip is calculated on a cumulative basis. National insurance, not so. Now, it's not all bad news. Small business support is headed on the slide. To help small businesses, the employment allowance would increase from 5,000 to 10,500. Whoa, some people know what that is, some don't. David Cameron introduced it. He even sent a letter to every employer with his facsimile of his signature on, saying, look, I'm giving you £1,000 a year. And everybody thought it was going to be a short-term thing, but in fact, it's been increased over the years. It's 5,000 in current tax year, 24-25. Next year, 10,500. So that means, and there are qualifying conditions, but that means that if you've got more than one person on the books, on the payroll, then the first £10,500 of employers' national insurance is just cancelled. That's That's quite big if you're a small company. Not so big if you've got hundreds of employees. The big companies like that used to not even qualify for it, but that threshold, there's a 100,000 threshold of employers' national insurance, that's been removed. So at least they ought to get this 10,500. The other big change for if you're employers, the national living wage, that's going up to £12.21. Another significant rise. And I'm not going to get into the politics of whether national living wage and national minimum wage, etc., are good things, but they will increase the earnings by about £1,400 for full-time workers. So that's quite a big benefit for the working people, but it's obviously a big burden for employers who've got maybe a lot of staff on just the minimum thresholds, maybe hospitality, bar staff, warehouse workers, etc., etc. And the national minimum wage for young people has, for some reason, has always been held really low. I think the idea was that it would mean that more young people could get jobs when they came out of school. Anyway, whether that's a good thing or a bad thing, whether it works or not, £10 an hour for 18 to 20-year-olds. Maybe it'll encourage more people to actually go in and really try and get a job. I don't know. Anyway, the additional costs from this employer's national insurance, maybe you take some of the hit yourself as a business owner. You accept lower profits, or maybe you do less investment. Maybe you keep wages lower than they would be. I'm not sure people would actually do that for existing employees. It's just not practical. But maybe you might reduce headcount by 1 if you have, say, 10 on the books, and that will cover it all. Maybe you can think, can I manage with 9 instead of 10? I don't know. Or obviously some of the costs, it's part of your cost base, but you have to take that into account when you're pricing your sales, whether it's services or goods or whatever. Maybe you have to pass it on to customers. Obviously, none of those options are ideal, but you may need to do them. You need to forecast and manage this. And really the key there is to work out what the impact is for you and your business. Don't go by what you see in the papers or on the BBC or any other channel. Do the sums for yourselves, and obviously we're here to help. Now, tax on employment, but it depends on the size of your company. Next slide. I've got a little table with some numbers which may be surprising. How will it affect a small company? And maybe it's a slightly artificial situation, because I'm looking at how bad the employer national insurance increase is for a company with 2 employees. So maybe that's artificial. Maybe you do have just 2 employees, or maybe it's you and your spouse on a typical salary dividend split. Every company is different. Every employer is different. So, 4 examples. Maybe you've got 2 people on 12,570. That's the same as it has been, in the sense that it matches the personal allowance and the threshold. It's the starting point for all the thresholds. I should just put it like that. Now, maybe you've got 2 employees being paid 22,222 next year. What a stupid number. Any ideas why that might be the number I picked for these 2 employees? As I used to say, answers on a postcard, but I'm not going to hold up the conversation for answers. That's the new national minimum wage for somebody working 40 hours a week. National living wage, I should say. Now, maybe you've got 2 employees on a proper salary, as it were. You know, the established proper salary. You have to pay money to keep people. Maybe you've got 2 people who are really high earners, maybe developers or something. Maybe they're key employees. So what's the national insurance bill in 24-25 in those these scenarios. It's nothing when they're at 12,570 because the employer's national insurance covers the little bit of, the employment allowance offsets this little bit of employer's national insurance that would be applied. The new national minimum wage, it's still nil. 40,000. Okay, there you've got a real bill in 24-25. 3,500, less than 10% of the total because of the thresholds that are employers' national insurance does not apply to. And obviously it's going to be a more meaty number for two people on 100,000. Got over 10% after allowing for the thresholds. So the real point, how will they apply next year? So for and there's been a lot of talk, people 12,570, now everything above 5,000 is going to have employer's national insurance, but it's still nil to pay because of the employment allowance. And what about the people at national living wage? Still nil. And interestingly, and it makes you realise she's really does focus on the detail. That's the Chancellor I'm talking about. For 24-25, you can keep it at nil with 3 employees, but with the increased employment allowance, for 25-26, that gets you up to 4 employees. Maybe that'll drive some employment in small companies, who knows? Okay, 2 people on 40,000. Now, that's real salary. What's the effect? Nothing to pay. Because don't forget, the employment allowance went up by 5,500, which is more than enough to swallow up this figure, plus the bit more it would be given the higher percentages. Okay, but what about if you've got 2 people on a lot? That's going to increase a lot, isn't it? No. Still only 18,000. So it's actually a decrease in that scenario. Now, I'm guessing those numbers were a bit surprising in some cases, maybe not. And it is an artificial scenario. If you have 10 employees, these numbers go out the window and your bills are likely to increase, but it depends on your company's payroll. It depends on what type of people you've got, what rates are being paid, how many of them are part-time, etc., etc. Okay, so maybe I've slayed a few dragons with that. I don't know. Maybe if you've got 25 employees, you think, yeah, okay, that may help somebody who's got 1 or 2 employees, but it doesn't help me. So next, tax. And there was a lot of talk about this next one going up a lot. Did increase, but maybe not as much as you might have feared. The standard rate of capital gains tax, and this is just basic background stuff. Capital gains tax, you pay that on what are called chargeable disposals. You don't pay it if you sell the house you live in. You do pay it if you sell, there may be some reliefs, but you sell some shares. If you sell a painting, importantly, you pay it if you sell crypto. If you sell Bitcoins, that's a capital gain. Well, unless they've gone down since you bought them, of course. So the lower rate, the basic rate, if your capital gain plus your income keep you within 50,000, you would have paid 10%. Now it's going to 18%. And these changes were as of the end of last week, or the day after the budget, or the day of the budget, I should say. Higher rate, that's gone from 20% to 24%. There was talk of the possibility, I'm sure they worked the numbers and thought about it. Why do people who make their money by selling things that they own, maybe they bought them with the intention of making a gain, doesn't turn it into income tax unless it's trading? That's a different discussion. Why do they get taxed only at 18 and 24%? They could have put these rates to 20% and 40% to be the same as income tax. So that did not apply. And don't forget, those rates do not apply to residential property. If you've got rental properties and you sell one at a gain and you don't have capital losses brought forward or get any other reliefs, then that doesn't change. Your buyer might pay more stamp duty, land tax with the changes there, but for you, there's nothing changed there. And when it comes to property, it's not a budget thing, but do remember the key date that sets the rate of capital gains tax on property disposal is exchange of contracts, not the date of completion. Then when you complete, you've got 60 days to do the declaration. It normally has to be done online and pay the capital gains tax. That starts from the date, the 60 days start at the date of completion. So if you exchanged before the budget but complete sometime later, you're still in 10% and 20%. Do be careful if you sell property. Solicitors are notorious for not telling you need to do the 60-day declaration, and you can clock up big penalties for being late. Fortunately, we've had one case in the office with a new client, but we're appealing those because they had no intention of not complying. Okay, now the next bold heading here, business asset disposal relief, BADR. Used to be called entrepreneurs relief. Why change the name? I don't know, but it did. Business asset disposal relief. So maybe you're thinking, well, yeah, maybe I can't remember what this is about. The point of entrepreneurs relief as it was, business asset disposal relief as it is that if you qualify, and the things that qualify are typically selling your business, selling assets used in your business. When I say selling your business, I mean as a sole trade or partnership, selling your assets that are used in your trade, or most likely selling the shares, i.e. selling your company. Important, remember, that's not your company selling its trade. This is you selling your company. And at the moment, if your business disposal, your cessation, whichever of the circumstances that applies for you, if you qualify for CGT, business asset disposal relief, you pay 10% tax. That finally is going. They use some weasel words to explain it, which kind of shied away from the fact they're actually almost withdrawing it. The rates will go up next year next year's meaning April onwards, up to 14%, and then they'll go up to 18%. So that could be a key action point, maybe just for you. The point being, where does it apply? It applies if you sell your business, but it also applies if you cease your trade and don't carry on a similar trade in another company. People who might be doing that might be contractors. We've had quite a lot of contractor clients down the years. When I say contractors, I mean not builders, subbies. I'm talking about IT contractors, other specialists, marketing analysts, that kind of thing. Typically in their world, maybe it's your world, you might have a company which trades for a short time or maybe a few years, and then you take a job, go permie, as they say in the contracting world, become a permanent employee. Then you can take the money out of your company, and it comes with 10% tax, not the unpleasant 33.75% you would pay as a high rate dividend tax. That's a huge benefit. Maybe you don't want to stop now. Maybe you're not going to go on the books as a permanent employee. Maybe you're not going to sell your business. But if you are thinking about those things, just maybe, it might be worth doing it before the 5th of April this year, or if that's not practical, making sure you do it before the 5th of April 26, just because you'll save the funds on the tax on the disposal or the tax on extracting the funds from your company. Be careful as a contractor if you're listening and you think, oh, I'll just close my company, get it out now, and then I'll form a new company. That doesn't work. There's a thing called the TAR. That's not my stupid accent only. It's TAR, Targeted Anti-Avoidance Rule. You can't start again. You can't phoenix the company within 2 years. Oh, and a point which I'm guessing probably doesn't really apply to many people here. There's another thing called investors relief, which works pretty much like business asset disposal relief. And a few years ago, they put both of them out so you could have up to 10 million across your lifetime attracting these reliefs. And then they brought down business asset disposal relief back down to 1 million, which is where it had been before. And for some reason, it feels like they forgot to bring investors relief down. I don't know if Mrs. Sunak did it by accident, forgot it by accident, no, or if he forgot it, or whether it's deliberate. But anyway, the investors relief, which is similar to a business asset disposal relief, is available if you invest in a trading company in certain circumstances and hold the shares for 3 years and then sell. Then you get investors relief, which is like business asset disposal relief for somebody who's setting up their own company. Okay, quite a lot of kind of technical content. The next slide, just a few specific bullets, some other things that might affect you or might well not. So I won't dwell on too long on each of them, but just to say, don't forget them. Making tax digital. Yes, a lot of people say, oh yeah. Well, I can't remember what that is. If you're trading through a company, it's not something you need to worry about yet, although you're probably already doing it for VAT. This is making tax digital for self-assessment, and it applies to sole traders and landlords, or it will apply. It comes in April 26. This budget, the big thing, my second arrow there, it is going ahead. There's been a lot of people campaigning for it not to go ahead, and it was postponed for a few years. It should have been in place for 2 or 3 years by now, but they've just postponed it more than once. But it's going ahead, and we all know it's actually going ahead now. It will mean you have to keep digital records and do quarterly tax, not VAT filings, quarterly tax filings for self-assessment. And obviously, frankly, it's really not going to be an issue for us because we use online cloud systems that already do quarterly filings for VAT, etc. Xero for trading and Hammock for landlords. If you use them, you know you like them, I hope. But if trading through a company, it's not for you. You don't need to worry about this for now. If just to say the thresholds where it kicks in, it starts at April 26 for people with an income, gross income, not profits, of 50,000. The following year for people with gross income of 30,000, and they confirmed that they will bring in another tranche of people whose total income is 20,000, somewhere within this parliament. And just one little thing, which some people may trip up over, those thresholds, 50,000, 30,000, 20,000, they are the total of your sole trade or partnership income share plus your renting. So if you've got 26,000 profits from a trade and 26,000 profits from letting, but you're over 50,000, you're in. And those same things will apply in 2 or 3 years' time to 20,000 thresholds. That's going to pull a lot of people in. Okay, now I thought about running numbers, having tables in this webinar, but I think it's just too complicated. Those of you who we advise on this, you will know that it feels like a game, like a board game almost. We play, I do tax planning for everybody before the tax year end. And it's primarily, not solely, primarily a question of how much should we finalise your director's remuneration at, and how much should we finalise your dividends at, which won't necessarily be the same amounts that you've drawn. And we've got to build other things into the equation. It used to be tax credits, they've gone, but also got to think about student loan repayments, employers' national insurance. Obviously, that's changed now. How many employees you've got? Is it just you? What your other incomes are outside the trade that we handle through Xero. There's too. So I thought there's too many variables. So as ever, I will be contacting every client and planning these ahead of April 25. But if you're worried, contact me now. Or if you've just got questions you're not from, just ask them. Child benefit. Why is this in a tax talk? Some of you will know, some of you will not know. If you have children and receive child benefit, there's a thing called the high income child benefit charge. And that is where you effectively pay back the child benefit if one of you, and it used to be 50,000, if one of you had total taxable income of more than 50,000. So the classic combination is that one person is not working or is at home part-time, just working part-time, looking after the children. One person is out trying to bring in a significant income to finance everything for the family. So the person looking after the children receives the child benefit, and the spouse, civil partner or household partner, pays it back through their self-assessment. You have to be careful with this. There's been a lot of cases where people had no idea they had to do this. Anyway, the change in this budget, it used to be that you pay back child benefit if one of you earned 50,000. That changed to 60,000 last year. Or was it the year before? I can't remember. But the previous Chancellor, Jeremy Hunt, said this is going to be changed, so it won't be based on the higher income earner, but it will be based on the household income. Rachel Reeves, I think, although it's not great that the higher earner is the one who pays it back, I think it's only practical. There are lots of scenarios which probably are not suitable for speaking to this audience about, but things that change when you count as a household. They're just not practical. It's just not practical to when life changes happen, shall we say, to suddenly think, oh yes, I must remember to tell the HMRC about the child benefit change. Okay, and now I'm going to switch across in the next slide to one of our specialisms, contractors. Now, when I'm talking about contractors, I'm talking about, as I said before, usually our clients, people on a significant day rate. Maybe they're implementing significant systems for significant enterprises, but they've got their own company, a personal service company. IR35, no changes. That's almost worth mentioning itself. I did mention it. IR35 is a mess. It's always been a mess. Partly because it's based on case law going back to the 19th century, the master and servant cases. But there's been a recent case, Supreme Court case, the referees case, the Professional Game Match Officials Limited case. That's going to be quite a significant change. It's not in the budget, but I think it changed the landscape a bit. It may make it harder to say that you're outside, as they say. And one change that is in the budget, umbrellas. Now, if you're not in this world, you may think, what is he talking about now? These are companies that large organizations just say, you'll be paid through this umbrella, or they're not allowed to say that. They say, you need to go through an umbrella company. What's an umbrella company? It's one where your end client or your agency doesn't handle your PAYE, doesn't handle the payroll. So umbrella companies kind of do the legwork, the back office. And you are, if you do go through an umbrella, you are employed by that umbrella. You are their employee. They used to be shockingly bad tax evaders, and I don't use that term lightly. They used to abuse the travel and subsistence rules, and they all argued or tried to sell their services based on how many pence in the pound they could get you. That changed a few years ago when the rules on travel expenses changed, but there's still bad apples in the umbrella world. And the big change is that and this may seem quite a technical change, if probably have, but yeah, if your umbrella company should fail to pay the taxes that are due on what they've paid you, then that money is then payable by the agency. Or if there's no agency between the umbrella and your end client, then by the end client. So this may seem a technical change, but I think it's going to have a huge impact. The end clients may not, they may, and the agencies in between the end clients and the umbrella companies, they may not want the risks that go with that. One of the problems is that umbrella companies, they've gone bust. They've just closed down, sometimes not even paying the contractors, but certainly if that's happened, they've probably not paid HMRC. If that happens now, it'll be the agency that has to pay the tax. And if not the agency, the end client. So it's going to be a difficult world for umbrellas. Only the really good ones will carry on. The agencies and the end clients may insist on doing due diligence, making sure things are handled. Or they may just say, look, big PLC may say to agency, employment agency, no, you do the payroll because we know you and we know what you do. The other thing affecting the contractor world is employers' national insurance. If you've been down this route, you'll know. If you are, and I've put inside, that means if the work means that you're not outside R35, if you're inside R35, then you can be going through your own trading company, your own personal service company. But the tax and national insurance will be deducted as if you were employed. So you'll probably end up going through an umbrella. But when they negotiate the day rates, the end client is looking at the overall cost, and they take that employer's national insurance out of the overall budget before they calculate the day rate that you will get. So these increase in employer's national insurance, especially if you're on a big day rate, could have a big impact. But then everything is negotiable in that world. If you're in a strong negotiating position, you can say, if you want me to carry on, if you want this project finished, keep the day rate higher, please, or as high as it is. But if you're in a strong, weaker negotiating position, they may say, we're imposing this. New contracts. As ever, IR35 world is difficult. The world seems to be turning against the flexibility of as what people in this world call the contingent workforce. Okay, now on to something which probably won't affect so many people. Inheritance tax. Now, a lot of people have only vague understandings of inheritance tax, and I should say we're not specialist inheritance tax advisors. We're happy to give you an inheritance tax advice in terms of whether you've have exposure. If there is sophisticated planning involved in implementing changes, maybe involving trusts, we would definitely bring in specialists that we work with. Inheritance tax, the way it works, if you die, obviously you can't pay tax, you've gone. But your estate will pay 40% tax on the total of your estate value to the extent it's above your nil rate band, the threshold, which might be 325,000, might be 650,000, or it might be more if the estate includes your family home. And special transfers are exempt. There's lots. It's like every other tax, very complicated. But a lot of people worry about it unnecessarily, because when typically I'll do the calculations for a small business client, and they'll say, "Oh, actually, I don't have an inheritance tax issue, do I? I can stop worrying." Of course, some people are complete cynical and say, "I don't care, I'll be gone." They can pay the tax. Everyone's got different attitudes to this one. The big change. This is not coming into effect now. April 27. See what it says on the slide. April 27. Pension pots, by which I mean your pension funds in a private pension, those have always been outside your estate. Well, assuming you have them set up correctly and took advice on it. We're not IFAs. If you need advice on this point, see your IFA, or we can give you really good contacts, really nice people who can help you. But now, private pension pots, if they can be passed on. If you still have one and it takes you over the threshold, add on an extra 200,000 or something, that will be included in your estate. Now we've got very little detail on this. The announcement is very, very thin on detail, and that's because there's all they've really announced is that it's going to happen, and there's a consultation. They're going to ask the providers. I had a really good conversation with a pensions advisor I know well yesterday, and the government is asking the providers, the Prudentials of this world, to do all the work, and probably ideally to bear some of the costs, but in the end they're not going to bear the costs, are they? But it's an incredibly complex thing to try and implement, because pensions are based on trust law. It's very difficult. And the other thing is, it's not clear. Will, having passed on your pension to somebody else after you've died, will they still pay income tax if they draw the pension? It can't be both, surely. We don't know. We just don't know. But it may change if you're involved in inheritance tax planning. If you've implemented some already, you need to take advice. If you're thinking about it, this has to be built in, but probably your advisor is going to say, yeah, we'll wait and see on that one. I don't take any rash action now, because probably what's been announced will change before April 27. And the way these things work, maybe even April 27 is ambitious as a start date. Now, the one that's got a lot of publicity, especially from a certain ex-Top Gear presenter, does he still do it? I don't know. Mr. Clarkson. Agricultural and business property relief. How does this work? Well, the point has been that if you have in your estate business or farm that's been excluded from the total that has inheritance tax applied to it, now only the first million. Only the first million. That's a nice world to be in, isn't it? But there's been, I won't dwell on this, but there's been a lot of nonsense publicity about this. I'm told that the Telegraph gave an example of a farm worth 5 million and the farmer dies, and that means there's 2 million to pay at 40%. And then they talk about how will that affect his wife and the 2 sons who work in the farm. Well, hang on. Surely they're partners, aren't they? If you had any tax advice, which gives them 4 million exempt, even under this reduced threshold. I don't know. Anyway, I'm going to move on from that, because I think there's been a lot of nonsense talked about it, and probably not many people in this room are affected by it. Again, changes to the relief for private business shares, and also the bans are staying the same until April 2030. They've been the same for a long time now. It's called fiscal drag. It's bringing more and more estates into inheritance tax, which never would have been. Okay, a bit more general this, and this stuff is good, really, not being political. The Chancellor has promised to keep things the same for the next 5 years, in almost all cases. And the point being, how can you plan? How can you run a business when the next thing you know, your accountant is saying, oh, these have changed. This is, all that stuff I told you last year, it's all changed again now. They're saying, going to keep things the same. There's a corporate business tax roadmap announced. Corporation tax, the higher rate of corporation tax paid by companies with profits more than 250,000 is 25%. They've promised that will not increase in this Parliament. If you're bringing in 40,000 profit, making 40,000 profit, your rate is not be 25%. There's a sliding scale, and it increases from 19 up to 25%. And they've promised those are all going to stay the same. There's a thing called associated companies that affects that. That's a nightmare for some people. I don't have time to cover it here. R&D tax relief and capital allowance is not going to change in the life of this Parliament. Thank goodness for that. R&D tax, if you're involved in making R&D tax credit claims, if you're thinking about maybe you qualify for one, do get in touch. We can help. There have been lots of changes in that over the last 2 or 3 years, but HMRC have been busy boys and girls. lots of challenges to claims, which they were really lax before. They've made lots of challenges to R&D tax credit claims. And what's R&D tax credit? If you're a profit-making company, it will reduce your corporation tax if your expenditure qualifies as research and development. And if you're a loss-making company, if your work involves research and development, you get money back. HMRC pay money to try and encourage research and development. But they've been challenging them massively. We've seen examples of there's two types going on. Very small claims, they challenge it, and you get the same challenge that you would if you had a large claim. So we've had clients saying that we just haven't had the time to argue about this, we'll just let it go. Also big claims, we've had very large claims where HMRC have been like a dog with a bone. They're pursuing claims and challenges to the claims, and it's involved a huge amount of work at our end, and the clients digging out emails and minutes from years ago, loads of technical analysis. I mean, not tax technical, but stuff that I wouldn't understand about, is this development work, is it not? Yeah, the change to the cars, it was a big change when electric vehicles came in. For the first ever time in all the years I've been working, I could advise clients to, yes, buy a car inside your company. I'm talking about shareholder directors here, not just employees. Buy an electric car. You get the big tax relief on the car, and the amount the employee, i.e. the directors in a lot of cases, have to pay for having the car is very, very low. And that's all extended into the future. The low benefit charge to the employee, the director, is extended, but do beware, especially given how long cars can last. Sorry, my fault, beg your pardon. They seem to think hybrid cars are not a thing. So hybrid cars are going to go back up to being charged the same amounts on the employees and directors and the company's employees' national insurance as petrol cars or diesel cars. I'm not sure why. Okay, coming towards the end, maybe you're pleased to learn. Some possible action points, not all from the budget, but mostly. Employer national insurance. One specific action point. Can your company qualify for the employment allowance? Does it qualify already? How does it qualify? Maybe you need somebody else on the books as an employee. You have to be slightly careful because that person has to be on the books for commercial reasons. You can't just bring in a family member who doesn't even know it's happening. And you can't pick a chap walking along the street and bring them in, because that could be challenged and you lose the employment allowance for years, and that would be a big bill to pay back, maybe up to 40,000. But it's definitely worth exploring. One thing to remember, to qualify for this, you don't have to employ somebody for a full year. They only have to be employed for one pay period. But in that pay period, they do need to do something to justify what they're being paid. But that's part of what we will build into the pre-tax year-end planning for all clients. If you're selling business assets, or maybe you're retiring and selling up, maybe you're thinking about leaving contracting, maybe accelerate your plans. Okay, there's a slight typo there. Maybe accelerate your plans to beat the April 24 and the April 25 capital gains tax rates changes. That's the business asset disposal relief changes. As ever, there's the oldest thing you've probably all heard me say: if your clients don't know the tax tail, wag the trading dog. Don't retire and sell up just because you can get 4% less to pay on what you extract. But if you maybe going to do it, maybe you need to do it sooner. If you're in an umbrella situation, check with your agency or end client. Are they going to be happy to carry on using the umbrella arrangement, or will your employment be shaken up again? And maybe you'll be employed by the agency or the end client. Or maybe this is your opportunity to break away and go contracting outside R35. Well, that could be more difficult. Not in the budget, but a reminder. If you were a client, you would have had a mail shot 18 months ago about checking your national insurance record. And we will be doing that mail shot again for this reason, before April 25. You need to check your national insurance record, by which if you've got one, log in. If you haven't got one, set up your personal digital tax account. You can check how many years of full contributions you've got and whether you will get full state pension. I'm not trying to go through it now, but if you haven't got a full record, you can top up the years by paying what's called Class 3 national insurance. And you can do that now going back. I can't remember the exact date you can go back to, but the chance to pay for contributions, 10, 15 years ago will stop after April 25. As I say, we'll be doing another mail shot on the topic. When they had the previous deadline, they just did not have the staff to handle the queries, so they had to extend it. Now, I'm not expert on this area, but business rates relief, that's a big saving for small businesses. And it's got complications in it, believe it or not. Funny enough, we were challenged by Leicester City Council for an office that we'd not, as it's saying, you had two offices all these years. Well, one of the ones we moved out more than 10 years ago. You should be careful with this stuff. But you be ready. Check your own business situation. If you've got premises, could you be hit with a business rates bill? Final thoughts. Well, there's lots of challenges for small businesses. The national insurance is possibly the biggest one for a lot of people. The capital taxes, capital gains tax and inheritance tax, the whole change with pensions and inheritance tax may change your ability to pass on things for future generations. And business owners, do take advice. In a sense, the worst thing that happens is when a client comes in, or a potential client, a new client, just comes in and they've been doing to save fees. They've been doing things themselves, and they've got things that they should have done years ago that they can't change now. Take advice. Okay, so I'm Malcolm Bill, Naked Accounting. I've had a very nice young man called Richard who's been facilitating this webinar. So I'm not sure if I can see the questions. I'll just check. If I have questions, I will try and deal with them now. I'll see if we've got 5 minutes in the allotted time. Yeah, okay. Has this government the potential to change things further during the next year? Is the question. Yes, it does. Yes, it does. There's a point I meant to mention. In the context of the business stability and the promises on income tax rates and corporation tax rates, what isn't promised is to keep dividend tax rates the same. And given they've promised to keep almost everything else the same and be stable, and that they have, based on the sums they did, a £7 billion hole that they haven't covered, maybe there might be changes. Could even be in next year's budget. They have promised no more spring and autumn. It should be next autumn before we get any changes. But there's an old thing, you've probably heard me say it. The only thing that stays the same in tax is that it always changes. Just always. Yeah. Do I recommend investing in electric vehicles? Yes, at the moment. And now that they've set out the rates for coming years, at least you've got some certainty. Could you put charging points? Yes. Charging points, very tax efficient. They know that you can't have an electric car without a charging point. But if you live in a terraced house, grand or modest, you may have trouble having a pure electric vehicle. the charging points on this different places, public places, are very expensive to use. If you can't have a fully electric car, but you need to have a hybrid car, be careful about the date you purchase, because the rates will be getting worse. Just thinking whether there's things that I've missed. And I had a whole list of points I wanted to cover. I think I've covered most of them. I suppose the overarching thing is our details are on the slide. If you've got questions, email them in. I'm malcolm@nakedaccounting.co.uk, or you can use the generic one email address, hello@nakedaccounting.co.uk. But we're happy to field queries from people who are not clients, because I know some people are really worried about asking questions. They think you might get £100 bill for a 5-minute consultation. You won't from us, for sure. Anissa, I'm just asking my colleague Anissa, is there anything else that you think I should be covering?
No, I think you've covered everything, Malcolm.
Okay. All right. Well, thank you for attending. I really appreciate you giving me an hour of your time. If you will charge me for that hour, it'll be expensive. But I really appreciate your time. Hopefully I've focused on the things that are relevant to you as business people, and one or two of the personal tax things, the child benefit charge, etc., which could impact you. Best of luck with this new parliament, and I wonder if in 12 months' time we'll be saying nothing's changed or lots of things have still changed again.